Hey everyone, we're here with Kinjal, who's an investor at Blockchain Capital. She'll be doing a talk on DeFi trends, what happened in DeFi this summer, and I will let her take it from here. Can you guys confirm in the chat that you can hear her?
Hey everyone. Thanks. Hey everyone. My name is Kinjal. I am an investor with Blockchain Capital. We're an early stage firm focused on investing in the blockchain sector. We've been around for about 7 years or so, and we're really excited about what's happening in DeFi and been following along for a couple of years. Thanks for tuning in today. So today I'm going to be talking a little bit more about what happened this summer and some of the higher level trends. Definitely want to provide a little bit of context here. So all of the sort of topics discussed, I think, are much more complex and deep, and I think the rest of this conference is going to do a great job kind of diving deeper. So today's conversation is really focused on sort of the high level takeaways and what kind of happened in aggregate over the course of 2020. And just to get started, always kind of have to start off with that usual disclaimer. This is not investment advice, so please do your own research. All of this is extremely experimental, early stage tech. So please do your own research before you invest. So what happened in 2020? We really saw the decentralized finance sector kind of explode this year. And while the space has been developing since early 2018, we've started to see a lot of the sort of building blocks get developed over the past few years. And then this year, it really took off in a meaningful way. This is the kind of chart to the right that you want to see when you build a product or when you find a market that's really kind of established itself and firmly positioned itself within the space. And total value locked is essentially a measure that we use within DeFi that kind of connotates the same as deposits. So this is just an indicator of how much capital is being put to use essentially in the space. And I think what really sort of kicked off what happened in 2020 this summer, or one of the few things, is the sort of state of protocols that are in the space. So a lot of decentralized finance has been building the pieces of exchange, lending, derivatives, and so on for some time now. And they've sort of established their community and their products, and then they launched governance tokens or other tokens. So in contrast to in 2017, when folks were just launching tokens, not necessarily before they've sort of built the product or built the community first, I think this just took a much more practical approach and really kind of worked with the community to launch something and develop something that the users would want. And there was economic activity occurring on chain, right? So a lot of these protocols are being used for exchange and lending in a real way. And the third thing that we really saw was composability in action. So composability is this idea that decentralized finance is built on open sort of protocols that are open source and shared. And you can kind of take one protocol and integrate it with another and create something new. And up until now, the pieces weren't quite there yet. So, and I would argue that they're still, heavily under development. But this was the first time that we really saw composability kind of move the needle a little bit and see different protocols being pieced together and integrated, and we kind of saw cross-protocol communities being developed. So I'm going to talk a little bit about different trends, and the first is liquidity mining, which I think is probably the biggest sort of phenomenon that happened this summer. So what is liquidity mining? So at a high level, liquidity mining is a community-based approach to liquidity, so to capital aggregation. And this is essentially when a protocol provides rewards or some sort of carrot in exchange for their users to provide liquidity with their idle crypto assets. And so this is, sort of the beauty of crypto assets is that they can be used productively in a smart contract simply by depositing your asset into a smart contract. And so on the protocol side, projects were able to bootstrap their liquidity and onboard new users. And on the user side, users were able to earn yield and optimize that yield and then participate in governance decisions and voting decisions. So it kind of created this win-win situation on both sides. And ultimately, I think the objective here was threefold and continues to be sort of explored across these three different dimensions. So the first is longer term liquidity and retention. There's a lot of projects out there who want to build a user base quickly, but also want to make sure that they have a sustainable platform and retain a lot of the users. And so liquidity mining was a way to, at first, do a lot of growth marketing. So kind of get your product out there in the hands of a number of people with the hope that you can, keep them around once they own your token or once they hold your token and participate in governance decisions. They have more incentive to stick around longer term. And this is not something new. This is something done by traditional companies all the time, different referral programs or, earn $10 of Bitcoin for signing up. But it was just done in a sort of novel way with the sort of liquidity provision. And then the third piece is network decentralization or distribution of tokens. So this is a question that a lot of projects have been grappling with, of how to distribute their tokens to their user bases and do it in a way that's effective. Liquidity mining turned out to be one way to kind of distribute your tokens and have some guidelines around how you distribute them, how much, and to who. And so I think the design of different liquidity mining programs is going to be continued to be explored and iterated upon. But this is sort of the high level why. And then the tokens themselves have a couple of different purposes. So we've seen proof of interaction tokens. So this is when a user earns a token for providing liquidity, and that's redeemed or staked later on. There's the governance. So most of these tokens provide a user with rights for voting within protocol decisions, and then platform rewards. And so this is a much more sort of creative category where you can have interest and yield, market making sort of fees being discounted, other sort of secondary protocol tokens being rewarded, and a number of other things. So we've got a token that's providing a lot of different incentives for the users, and the protocol is able to bootstrap their network early on. And this is a snapshot. This is as of August 21st, provided by Masari. So this is a little bit older, but ultimately you can sort of see here that total daily rewards were totaling 7.3 million, which is equivalent to 2.6 billion in a year. So this is liquidity mining programs on a massive scale. Things have definitely changed to a certain degree today, and I think there's been a lot of experimentation, but just kind of goes to show that this was the sort of main driver of liquidity aggregation and being driven up across all these different protocols. And we saw a number of new protocols being launched kind of with this yield farming, liquidity mining incentive. The second sort of broader trend that I think is definitely worth sort of exploring a little further is CeFi and DeFi sort of meeting each other. And so when I talk about centralized finance, I'm really talking about centralized crypto finance. So this is the Coinbases and the Binances of the world, not so much traditional FIs. I think that's a little bit further out. But decentralized finance has really been known to be a sort of retail phenomenon. So this is something that a lot of retail users are investing in. But in order for the growth that people want to see in DeFi to really happen, I think it needs to expand beyond just the retail users into centralized finance. And so we kind of saw this start to take place this summer with Binance and their DEX, FTX launching Serum, Coinbase listed many of the DeFi tokens early on, and there's been rumors about a token issuance platform. I think centralized finance is essentially saying this is an area that's growing rapidly. There's a lot of innovation, and there's a place for us to play. There's a role for us to play here as well. And so I think this is a theme that we're going to continue to see play out over the next couple of years as the two sort of siloed worlds come together. And a couple of ways that I think would be interesting for this to happen, and I think we're starting to see, is the following. So first, asset management strategies I think are really interesting, where potentially there's new products that can be built using DeFi tokens or using DeFi protocols and offering them on a centralized platform. I think this kind of maybe diminishes away at the decentralized nature of that DeFi is really trying to move towards. But I think it's a spectrum at the end of the day, and that you're not going to get all your users on the DeFi side of things. And so this is one way that I think the two groups will kind of meet. Another is stablecoins. So stablecoins, really are the backbone of the ecosystem. They are, the primary trading pair and just have been used extensively. And so they're both prominent on centralized exchanges as well as in DeFi. And so I think this is an area that we'll see a lot of overlap, kind of the on ramps into the DeFi world. And then lastly is middleware or infrastructure, however you might sort of define that. So a lot of the protocols that are being built in the DeFi world really are infrastructure for, plumbing for future financial services. And I think that they can be utilized both by centralized finance as well as, the DeFi community. And I think there's going to be some integrations there that'll be really exciting. The third sort of trend that I think is a big one from this summer is forking. So just to pause for a second, forking is essentially when you copy and paste somebody else's code and you deploy it. Given that decentralized finance is all open source, these are all protocols that are building in the open and sort of sharing their code, it's very easy to fork. But I think there's different strategies when it comes to forking and different implications that all protocols are now really, starting to become aware of. So whether that's sort of the pump and dump fork. So these are the forks that kind of forked away a protocol really quickly, launched some liquidity mining program, and gained a lot of liquidity quickly, but then didn't do much from there. I think those types of forks are going to be, potentially less impactful than someone who's forking a protocol, but then building on it and innovating even further. And I think it's really going to be a point of sort of contention within the community of how to competitively differentiate yourself with the risk of a fork. What are sort of strategies that you can use to defend your protocol? We've seen some of the biggest projects in the space get forked this year. So from Compound to Uniswap to Curve, there's just been a lot of forking and some interesting tales. But I think at the end of the day, the projects that are putting in the work to build their community, to build their brand, go through sort of all the hoops of making sure that their code is up to snuff, they are coming away as the winners. There might be sort of a short-term jump for Cream or some of these other protocols, and I think some of these protocols are looking to build more in the space and kind of develop their own brand. But at the end of the day, I think brand and competitive moat really comes down to the community that you've built, and we kind of saw that come to life this year. So it's certainly not the end, and I think there's a lot more to sort of be explored in the forking category. The fourth is stablecoins. So I think stablecoins were kind of the underdog story of the year. So stablecoin issuance this year went from about $5.5 billion to nearly $20 billion. So that's a 4x jump in the course of 2020 for a market that's been around for a couple of years, but really kind of exploded this year. And I think that happened for a few reasons. The first is that crypto activity and trading, of course, exploded, and stablecoins are the dominant trading pair when it comes to these markets. The other thing is that 2020 was a crazy year from a macro perspective, and so there was certainly a little bit of demand for USD that increased, and stablecoins is effective way to get exposure to the USD. And so I think that contributed in part to it a little bit. And I think the infrastructure was just really there. So whether that's global exchanges, global wallets, on-ramps and off-ramps, we've just matured a lot more over the past few years. So when there's increased demand for stablecoins, we were kind of able to support that across the market. And I really think of stablecoins as sort of the backbone of DeFi. They play such a large role in how users engage with different exchanges, wallets. There's a lot of use cases around payments, infrastructure. We've seen stablecoins, everything from the sort of DeFi stablecoins like DAI to Tether, which has 80% of the market, to new launches like Terra. This is just an area that I think is going to continue to grow, and particularly as we see CBDCs and that sort of narrative take off, I think the importance of these assets is going to continue to expand and kind of grow with the DeFi space. So certainly one of the most interesting trends of 2020. The fifth trend is about automated market makers, so AMMs. So AMMs are a class of DEXs. So decentralized exchanges were launched, a few years ago, and people were really excited about this idea of creating an exchange using decentralized technology. However, they didn't quite take off the way that the market sort of envisioned for a number of reasons. But I think at the end of the day, they just weren't quite as effective as we wanted them to be from a user experience perspective. And AMMs have kind of changed the game. So these are DEXs that are powered by algorithms that essentially require, or rather, they essentially provide liquidity at any given time. So there's always a market price at the time of a swap. And no matter how limited your liquidity may be, you'll still be able to find a price. And so the reason why this has been super effective, I think, in DeFi is two reasons. First is that you can bootstrap your token really early on and launch on an exchange like Uniswap. And second is that it helps sort of contribute to price discovery in your early days when that's really difficult to do. And so we saw this happen, with Uniswap really being the leader here, but a number of other projects have come out in the AMM sort of universe, whether that's something more specialized like building for stablecoins or other sort of variations on this. And I think, AMMs kind of rose to glory this year. And the sort of pinnacle moment was when Uniswap surpassed Coinbase in monthly trade volume. So just sort of to be able to see a project like Uniswap go from where they were in January 2020 to September 2020 is just, kind of insane and really exciting for the space. And just kind of goes to show that these platforms are, scaling, and there are certainly challenges, but that they are, comparable to the sort of centralized exchanges of the world. Something that I think if you had asked any of us a couple of years ago, we might not have been able to predict. The sixth trend is just talking about risks really quickly. So, I think a lot of folks are really aware of the risks, but I think this year in particular, it's kind of expanded to a new level where a lot of the risks are being sort of layered on top of each other. And there's just many unknowns. So whether it's smart contract risk, regulation, which I think regulators are going to be a little bit slower to respond to DeFi, but I don't think that means that they're not paying attention. And I don't think that means that there aren't going to be implications. It's just going to take a while, I think, for that to kind of come to the public. And so regulation is really important. Different attack vectors and sort of the attack surface is expanding as we build out these sort of composable new protocols that are dependent on various sort of points of failure. And then I think there's also just this idea of founder risk within DeFi that isn't completely gone. And so this is when you've got a founder or a team that's really representative of a project. And if something sort of happens negatively around this founder, then it really hurts the project and its prospects. And so there's a number of different risks here. I think this year we made a lot of progress with projects who are looking to help solve these risks and manage it. So folks like Nexus Mutual or Block Native or Cozy Finance, I think there's a lot of really amazing teams that are working on it, but it's still such a huge sort of unknown in the market and thing that we really need to be paying attention to. And the last sort of big trend that I think we saw this summer was aggregation and the implications for adoption. So, if you zoom out on DeFi's like big picture idea and what DeFi really wants to be, it's this idea that you can get financial services anywhere in the world with an internet connection, and that they're open and accessible. And yet the way that we've kind of built to DeFi today is, pretty complex and with a lot of products that can be challenging to use and challenging to understand. And so at the end of the day, aggregators are going to be really important for abstracting away some of that complexity, for managing different types of aggregation. So on the exchange side or lending or from a wallet perspective, I think this idea of DeFi aggregation is going to continue to grow and provide a lot of value to the end user. And I really liked this sort of comparison that Masari put out, which compares aggregation to how aggregation has worked in the equity markets and whether the value will accrue there. And I think this is a big question that we've had for many years of whether the protocol will accrue value or the applications on top. And I think we're starting to sort of see a clear path for how the value of these applications is really going to grow. So I think this is going to be important for adoption. And in terms of just how adoption has moved over the past year, MetaMask put out this chart in a blog post a week or two ago that showed that they've crossed 1 million monthly active users. And it sounds like maybe 1 million doesn't sound like a crazy number, but I think within DeFi, it really shows how we've moved the needle. Last year, this number was somewhere around 250,000 at the end of last year. So this is a massive increase in the number of users that are interacting with DeFi and just engaging with the space through a wallet like MetaMask. And so if you zoom out on the total available market of crypto users today, this is about 1% of that market, and just shows how much room there is to grow despite having seen all this growth already, which I think is just really exciting. I think there's a lot more to be done. So in summary, DeFi has been a whirlwind this year. I think 1 hour, this is a totally right sort of meme here, that 1 hour here is like 7 years on Earth. It's been, I think, a lot to sort of keep up with, and a lot of sort of innovation that was packed into a short period of time. But it's great because now the market can kind of reflect on what happened this summer, learn from the different sort of projects and circumstances, and then iterate and continue to build. And it's an area that I'm really excited about. That I hope that we see a lot more come to the market in the next couple of years. So with that, I will pause and kind of jump over to the questions, and I'm happy to answer any questions if you want to drop any of them into the chat. Not sure if I'm seeing any questions, but if you have any, yeah, feel free to kind of drop them in, and I'll be watching the chat for a minute or two here. Yeah, so I mentioned the term CBDCs. That's really referring to central bank digital currencies. And so this idea that central banks are going to be looking to launch digital currencies, we've seen this with China. So China is launching what's called a DCEP digital currency. And we've seen a lot of comments out of the Euro and out of the UK saying they want to explore this idea as well. So that's kind of what I was referring to. And I would put CBDCs in a similar bucket as stablecoins. They're not the same, but I think it's a sort of similar sort of competitive idea. Another question I see here is about CeFi interacting with DeFi. How do I kind of envision that happening moving forward? Do I think CeFi will hijack some of the volumes or maybe implement some of the innovation? I personally really hope to see that centralized finance implement some of the innovation that's happening in DeFi. I think that's really the sort of novelty of using protocols and smart contracts, is by being able to build things like Aave and Uniswap and Compound. And so I think centralized finance will work to do that. I think we've already seen it with FTX launching Serum on Solana. We're starting to see it with Binance launching their own DEX and having projects sort of built on Binance smart chain. And then I think with Coinbase, I think that's the one that'll be one to watch, is how far they kind of lean into the space. I think they've historically really wanted to embrace it, but have had a very careful regulatory posture. And so it'll be interesting to see how they kind of embrace the ecosystem. But I think at the end of the day, they're going to want to engage and interact just because there's so much activity happening. So I think there'll be varying degrees of sort of interaction there. In terms of founder risks, so I think founder risk is kind of an interesting idea within crypto for two reasons. One is that the space is kind of built on this idea of decentralized participation and not having any one owner or one CEO of a protocol. But at the same time, there's obviously teams working on these projects and kind of have these monumental figures. We have, of course, we have like Vitalik with Ethereum, and there's many others. But I think there's a little bit of risk associated with founders who, may or may not be acting in the best interest of the community. So, for example, SushiSwap was a protocol that forked this summer. They really grew in their sort of liquidity pools, and the founder exited and sold some of their tokens, and it was a little bit. It just kind of ruffled the feathers of the community. They kind of walked away with, I think, $13 million or something like that. And then they decided to return that money, but I think it just kind of left a little bit of a bad taste in the mouth of users. So that's one example. And I think we're going to kind of continue to see that play out, and just kind of need for founders to be really careful and avoid, mixing the two, that a protocol is sort of defined by one person. Let's few other questions. How can institutions participate in DeFi? It's a really good question. I think it's one that people are starting to think about and explore, but it's very challenging given the risks associated with the space, and just sort of the infrastructure and even the trade sort of size volume is potentially just not quite there for super large institutions to get involved. I think one thing we will start to see is sort of like specialized asset management strategies. So maybe someone who is offering a way for institutions to participate, and they're kind of acting as a robo-advisor, and they're managing the yield and sort of optimizing their yield by investing their capital into a bunch of different liquidity pools. So that's one way that I think could be really interesting. But I think there's a lot left to sort of discover. Do you see government regulation having a positive or negative impact? So it's a really tough question. I think there's going to be a mixed reaction for sure. I think right now, decentralized finance is relatively under-regulated, in the sense that, I'm not a regulatory expert at all, but I would say it's kind of flying under the radar right now. But I think there's going to be certainly a little bit of a magnifying glass on how tokens are being launched, whether tokens are securities or not, different sort of exchanges that are being operated. I think there's just going to be a little bit of a gray period where it's not 100% clear. At the end of the day, I'd like to think that the innovation happening in DeFi is welcome and something that we really want to see succeed in the world. But I think it might be a little bit of a prickly path, just trying to get to what that actually looks like. So it might be kind of a little bit tougher in the shorter term, hopefully longer term, something that's embraced. There's a question about L2 solutions. So, DeFi, of course, a trend that I didn't highlight here, but is super relevant, is high gas prices. And we saw a lot of congestion on Ethereum this year. And this has turned the focus over to layer 2. This has turned the focus to new chains, different scalability solutions. And I think this is a really interesting story, something that we've been aware of since 2017, but it's really coming to force today and reckon today, because we need a lot of these solutions. So I totally understand that layer 2 solutions don't support composability as well. I think that there's hopefully going to be a little bit more that happens in the interoperability landscape. So allowing for assets to be used across different protocols and potentially scale that way, in that they're not all being used only on one ecosystem. But I think it's a little bit tough when it comes to the composability. There's just so much to be figured out, and I guess there's no one sort of correct answer here that I can point to right now. I will do one more question. So in terms of where I think DeFi is headed, and just I think where I sort of see the next couple of years playing out, I think we're going to see a lot more sort of innovation happen up the stack. So what I mean by that is we've got a lot of layer one sort of launches that are happening, but I think there's going to be a lot of sort of innovation happen with layer two scaling, with building sort of composable protocols, with the application layer engaging and interacting with the different DeFi protocols that already existed. So I'm really excited about sort of seeing how that progresses. And then I think the second idea is just broader usability. So adoption. I really am excited and hopeful that DeFi is going to become a place where we really are reaching sort of the depths of the world in terms of who can access these financial services and actually use them. And so that's really where I hope the space kind of continues to head towards and keeps that as a goalpost, if you might say. I think I am just about out of time here, but thank you all for watching. And if you have any questions, please feel free to send me an email or find me on Twitter. And yeah, I would love to chat more. Thank you again.
Thanks, everyone. We're going to transition to next talk now.